Oh, if you're already sick of soaring home insurance bills, you're not going to like what you're about to see. It's an often untold part of the story of how we got into this mess and how state lawmakers who tried to fix it did not have all the facts.
We've been trying to solve a problem without the actual data to support the information.
Well, first, remember the insurance lobby and the governor claimed that our bills were shooting up due to a combination of abusive lawsuits and fraud. So we'll start with fraud. And by that, they mean contractors claim roofs have storm damage when they really don't, and then get insurance to wrongly pay for a whole new roof.
And I'm watching them canvass the neighborhood, knocking on door after door after door after door after door after door. And then we come back 3 weeks later to do the insurance inspections for the closing, and there they all are, bang, 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 putting roofs on everywhere.
And this kind of fraud could be rampant, but we can find no data to back that up, and very few arrests based on our public records request, which incidentally took us more than a year to receive. Look at this. In 2018, when state leaders say that this type of fraud really took off, state agents only made a total of 53 arrests statewide. And then in 2019, they dropped to 37 arrests statewide. And in 2020, they dipped to 22 statewide.
There's a disconnect. There's some system that's not in place. I don't know if it's somebody not doing their job or just some system that we don't have. I don't know. But it's not getting done.
Now, on claims of lawsuit abuse, the governor and state lawmakers' reforms focused on making it harder to sue insurance companies because they said bogus lawsuits and all the cost of litigation were driving up our premiums.
We have about 8% of the insurance claims for homeowners nationwide. The state represents 78% of all the litigation.
Now, here's some important context. That stat that we heard over and over again, well, it originated with former state insurance commissioner David Altmaier and an insurance group that he led. And it's based in part on information that we cannot see because it's confidential, and data that excluded some markets, and data that former insurance regulator, economist, and consumer watchdog Bernie Birnbaum says lacks context.
There certainly was more litigation among certain companies in Florida than you'd find in other states, but over half of the companies had very little or no litigation.
What does that tell you?
It says that it's not an industry-wide problem.
Remember, Florida has a very different mix of insurance companies writing policies here than other states have. So Florida may have just had a comparatively smaller number of companies getting disproportionately sued for either slow walking or lowballing or wrongly denying claims. And as for the notion that has been driving up our bills, here are some more stats that state lawmakers do not mention or may not have known.
Florida did have a higher claim settlement expense ratio of 13 cents on the dollar, but it was only 3.5 cents greater than the countrywide average of 9.5 cents.
And to cut to the chase, here's what that appears to suggest.
The cost of the so-called frivolous, and I put that in quotes, litigation is a few pennies of the premium dollar, nothing of the magnitude to drive the premium increases that we've seen.
But state leaders still made what they call drastic changes that make it harder for homeowners to sue their insurance companies when those insurance companies do not pay claims. All while a 2023 national analysis from AM Best did not list litigation as a factor in insurance company failures, while research from the Florida CFO's office did not list litigation as a factor in insurance company failures, while insolvency reports on the CFO's site also do not mention litigation either, but instead point to something else. For example, this one on the failure of Sawgrass Insurance states that the cause of failure appears to stem from company mismanagement.
One of the things I'm very concerned about is this company had no financial exams from the state of Florida since 2011. And I'm wondering if maybe more effective oversight I'm actually confident that more effective oversight would have helped to avoid this disaster.
Well, in 2023, the legislature considered, but then backed away from something that consumer watchdogs like Doug Quinn say we need.
They removed the clause that required transparency in profits of insurance companies, in payments to affiliates.
Now, for background, after a rash of hurricanes years and years ago, many of the larger established insurance companies pulled back or completely pulled out of the Florida market. And then smaller, lesser known companies filled in some of the void. And we're talking here about some companies that do not have the same legacy and focus on home insurance as some of the well-known national players.
You may have a hedge fund that is anchored offshore. They may even be domestic, but they'll own a holding company. And the holding company now owns 7, 8, or 10 different companies. One of them is the insurance company.
Those insurance companies can make money and then pay their sister companies, which, who knows, may be a mix of administrators, adjusting firms, reinsurance firms, or restoration companies, moving money from the insurance business where there are caps on profits and strict regulations and risk of claim loss to their sister companies where there are not.
And listen, it's all good as long as you're honoring your policies.
But in prior years, we've seen insurance companies make large executive payouts and pay millions to their subsidiaries as those same insurance companies went broke, leaving policyholders holding the bag while competition shrinks and prices go up. Again, in 2023, with that in mind, the legislature drafted a reform to require insurers to disclose their financial stability, their profits, and their payments to their sister and parent companies. But then they removed that because they were concerned about placing additional burdens on companies in financial distress. But now, 2 years later, we now know something very important that lawmakers did not. The Florida Office of Insurance Regulation looked into the situation after Hurricanes Irma in 2017 and Michael in 2018. And from 2017 to 2019, they reviewed 53 companies, and not counting the outliers, they found that the insurance companies did in fact lose money, $432 million, but their affiliates made $1.8 billion. And if you do count the outliers, well, then the insurance companies didn't lose money. They made $61 million, get this, while the affiliates made $14 billion, while state lawmakers said that they were in financial distress and later offered them billions in state subsidies and legal reforms in their favor. But state lawmakers did not know about that report until now, 2 years after the Times-Herald records request, because the Office of Insurance Regulation called it a draft, and so the state's insurance regulators did not release their findings to the state lawmakers when they were drafting reforms, leaving us with a crisis and the lawmakers in the dark.
The CEOs and the C-suite and the boardroom gets to benefit. Meanwhile, our consumers and constituents are suffering and still have homes that have not been rebuilt.
Well, State House Democrats are now calling for an investigation, and the full legislature has a chance to revisit all of this and try again when their regular session starts this week.